All right, let's talk about something that's probably been on your plate at least once this week. French fries. And chances are, the company we're looking at today, Weston, is the one that made them. We're about to do a deep dive into this global giant of the potato world.
And that's really the big question, isn't it? You've eaten their fries, for sure. But does that mean you should own their stock? I mean, they supply pretty much everyone, from the biggest fast food joints to your local grocery store. But does a full plate automatically mean a full wallet for investors? Let's find out if this is a hidden gem hiding in plain sight.
So here's how we're going to tackle this. First, we'll get to know the business. Then we'll crack the code on its valuation, do a deep dive on all the numbers, weigh the good against the bad, and then, the big finale, figure out what the right price to buy actually is. Let's get into it.
All right, first things first. Who exactly is Weston? And what's their secret sauce for making money?
You know, it's actually a pretty brilliant and simple business model when you think about it. They take a regular old potato, something you can buy for next to nothing, and turn it into all these valuable frozen products. Fries, wedges, you name it. And the best part? They lock in their customers, the big restaurant chains, with long-term contracts. That means they have a super steady, predictable stream of demand. It's a great setup.
Okay, now for the fun part. Let's get to the heart of our investigation. What is this company really worth, and what's the market willing to pay for it right now? Because as you'll see, this is where a really interesting story starts to unfold.
So let's look at the first piece of the puzzle, the price tag. As of right now, the market says one share of Weston is worth $49. That's the number that all the buying and selling has settled on. It's what everyone thinks it's worth today.
But, and this is a big but, here's where things get juicy. This analysis suggests the company's intrinsic value, what its fundamentals say it's actually worth, is closer to $61. Whoa, that's a gap of more than 20%. So the huge question is, what is the market not seeing here?
And look, this isn't just one magic number pulled out of thin air. No matter how you slice it, whether you're using a discounted cash flow model or looking at its earnings multiples, the story is the same. The value seems to be way higher than the current price. Even a metric like the PEG ratio, which is a neat way to balance price with growth and dividends, is sitting under 1. And that's usually a big sign that you might be looking at a bargain.
So, to figure out why there's this 20% plus gap, we've got to dig deeper. It's time to put Weston under the microscope and really look at the evidence. What are its real strengths? What are the weaknesses? And how's it really performing?
Every great company needs a moat, right? Something to protect it from competitors. For Weston, it's not some famous brand name you'd recognize on a bag of fries. No, their moat is all about operations. Just think about it. If you're a massive chain like McDonald's, could you just switch your fry supplier overnight? No way. It would be a total nightmare. Quality control, new contracts, redoing your entire supply chain. That massive headache is Weston's moat, and it's a powerful one.
Okay, but it's not all sunshine and roses. Here's the big issue that seems to have Wall Street spooked. Look at their profit margins. They've been squeezed big time. We're talking a drop from an average of almost 10% over the last decade, down to just over 6% now. And why? Well, you've probably guessed it, rising costs for everything from the potatoes themselves to energy and shipping. So the multi-million-dollar question for any investor is this just a temporary problem, or is this the new normal? And here's another potential red flag we need to talk about: debt. Their debt-to-equity ratio is over 2, which is just a fancy way of saying they use a lot of borrowed money to run the company. Now, that's not always a bad thing. It can boost returns when times are good, but it's a double-edged sword. It also cranks up the risk, especially in a world where interest rates might keep going up. So what about the folks in the driver's seat? How's management doing? Well, it's a bit of a mixed bag, but mostly positive. They're doing shareholder-friendly things like buying back stock and paying out dividends. That's always good to see. On the flip side, they've made some big purchases recently that have added to that debt we just talked about. But here's the key: their return on invested capital is over 10%. That tells us they're actually making good money on the cash they're putting to work. They're creating real value.
Okay, so we've looked at the nitty-gritty details. Now let's pull back and look at the whole landscape. Let's weigh all the strengths against the risks and try to imagine a few different ways this could all play out for Weston. This chart really paints a clear picture. On one hand, you've got these huge strengths, right? Their massive scale, those super stable contracts, they get high marks. But on the other side of the scale, you have the risks, those shaky profit margins and the debt, and they're given just as much importance. It all adds up to a balanced picture. This is a solid company for sure,
but it's sailing against some pretty strong headwinds right now. The question is, can they manage them?
So based on all that, we can game out 3 different futures. Let's call them the good, the bad, and the most likely. In the bear case, the bad one, costs stay high and the stock's probably worth around $52. In the optimistic bull case, margins snap back. And hey, we could be looking at a $74 stock. But the base case, which assumes things just kind of get back to normal, puts us right back at that $61 value we talked about earlier.
Okay, this is the moment we've been building towards. After all this digging, what's the right price? When should you actually consider buying in? The analysis we're following here set a very specific target, a 9% average return per year. So let's see what price you'd have to pay to hit that goal.
Now, this is really interesting. This table shows that the price you can afford to pay really depends on how long you plan to stick around. To hit that 9% target, if you're only investing for 5 years, you could buy in as high as $55. But if you're in it for the long haul, say 16 years, you need to be much more patient. Your entry price has to be a lot lower. And here it is, the bottom line. If your goal is to make an average of 9% a year over a long 16-year period, this analysis says your buy price has to be $46 or less. That's the magic number that gives you the cushion, the margin of safety you need.
All right, let's put it all together. We've looked at the evidence, we've weighed the pros and cons. It's time for the final verdict from this analysis.
And I think this quote from the source material just says it all perfectly. The whole idea here is that the market is just being way too pessimistic right now. It's looking at those squeezed profit margins and acting like they're going to last forever, when there's a good chance it's just a temporary bump in the road.
So let's wrap this up. What are the key takeaways? Well, first, Lamb Weston is a simple and really resilient business. Second, the stock looks like it's trading at a nice discount, maybe 20% undervalued. Third, the main risks, those margin issues and the debt, are definitely real, but they probably aren't permanent. And that all leads to the final point. This looks like a buy, but with a big condition. For a long-term investor aiming for a 9% return, the price has to be right. And that price is below $46.
And there you have it, a deep dive into Lamb Weston, the quiet giant behind the fries on your plate. So now I'd love to hear from you. What company should we put under the microscope next? Let me know in the comments.